Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Today, Portfolio Manager and Director of Research Reetu Kumra joins host Pamela Ritchie to give an update on the Canadian Long-Short Alternative Fund and what alternative investing trends she's keeping an eye on. Reetu talks about the fund's positioning and describes the 4 super sectors she keeps an eye on: interest rate sensitive sectors, resources, consumer, and industrials. She says the Canadian Long-Short Alternative Fund aims to generate alpha within the super sectors while being largely neutral across them. Reetu says there's no crypto in the fund. Crypto is seen as a diversifier, but she does add that research has shown that adding a 1 to 3% slice of Bitcoin to a traditional 60-40 portfolio can increase risk-adjusted returns by 12 to 34%. She also talks about the recent rate cuts by the Bank of Canada and how that affects the fund, and how the fund leverages Fidelity's strong research platform and aims to capture Fidelity's high-quality research by going long on buy-rated names and short on sell-rated names. This podcast was recorded on September 25th, 2024.
Okay, let's talk a little bit about the Canadian rate discussion, what you're seeing, what we've seen. Ultimately, we want to get to what it means for your fund, but we've seen a bunch of cuts. Sounds like there's more on the way. This is a good thing.
Yes, absolutely. So when we think about Canada specifically, so I'll just tailor the discussion to Canada. It's interesting. It's in this market we have both headwinds and we have tailwinds. Consensus out there is very much focused on the headwinds, but let's just start off with the tailwinds in this market. We have a really strong regulatory framework. We have a stable political system, and we're very centered around commodities. It's a very resource-driven market, similar to what you see in Australia. And so for those investors who are interested in the commodity story, whether it's driven by the stimulus that we saw yesterday that you just mentioned, could be a reflation trade, geopolitical risk, Canada is a good market to actually invest in as a result. The headwinds, which is more commonly discussed, would be the consumer, the levered consumer that we all know about, the wave of mortgage maturities that are coming due. We have, a potential non-zero recession risk. And of course, structurally, high taxes here. So you marry that together, and while the focus is primarily on the headwinds, secretly, what we've seen is the TSX has actually outperformed almost 15% year to date.
It's been a good year for Canada.
It's been a great year for Canada. Yeah. And the headwinds that we just talked about, the Bank of Canada also knows about. And so we've gotten 3 cuts so far. There's the market's expecting another 3 cuts on its way. And so at this point, the market, we're expecting about mid to high single-digit EPS growth. The market's trading at roughly 15 times earnings. And so, it's not a bad place to be in. But, right. When we think about Canada, we think about, okay, so what are the opportunities here from a security selection standpoint? And that's what we're focused on. So not only what the fundamentals are, but what is being priced into the market.
So this is what Fidelity does so well. This is the research. You're the director of research. How does this fund express what you do every day with that particular hat on, like director of research? Tell us how that's connected exactly to this fund particularly, and then we'll go into how it works. But
yeah, absolutely. So with respect to this fund, so just to kind of level set a little bit, the Fidelity Canadian Long-Short Alternative Fund is a 130/30 long-short fund. Mm-hmm. And it's primarily all about, it just really harnesses the breadth and the depth of our research platform. And so we launched this fund. It was launched earlier on this year commercially, but we've actually been working on this since 2020. And it was born out of a research study that we had done back in 2019 in conjunction with our quant team. And as you can imagine, at Fidelity, we have quite a bit in the way of data, whether it's data on our research ratings, how they did, how they performed, relative ratings, rating changes. So we wanted to see if there were any sort of systematic patterns in this research data that we have. So we went back 18 years and we sliced and diced the data. And we came out with two key conclusions, which drove the genesis of this fund. The first one is we are very accurate with our research ratings. But we were actually pretty surprised over the accuracy rate, but not only that, the consistency of the research over time. And the second piece, which
does that mean the consistency of the research? The consistency of it being accurate?
That's exactly it. It's been very consistent over time.
Okay.
And then the other piece is that while we knew that we were good at identifying securities that are buys, we actually do an even better job of identifying securities that are sells. And so many people, I'm sure, recall the scissors chart that we always put up. And so that's basically that shows how strong we are with our buys and our sells. And so we took this and we thought that it would be a great idea to create a fund that's primarily Canadian centric, where we can leverage the broader research platform and go long on our buy rated names and go short on our sell rated names. And so taking this, we have a rules-based approach such that we can try to maximize returns while just managing risks through the cycle. So what this fund does is it's really a core Canadian diversified fund, a 130-30 that gives directional alignment to that of the market while accessing our broader research platform by going long on our buy rated names and going short on our sell rated names. So we can actually capture that consistency, that accuracy, and just the repeatability of the research process. What I think is really interesting about the study that we did was that, as you can imagine, over 18 years, we have had plenty of analysts circle through the TSX, as well as using the investment process that we have here at Fidelity, using that Fidelity scale. And so that really speaks to the competitive advantages that we have within our research.
Okay. And what about the rebalancing piece of it? This is something that I'm sure you're extremely careful and cautious about. Tell us about how quickly you need to go in there and take a look at how the market is swaying things one way or the other.
So that's a great question. Just from a portfolio construction standpoint, we are constantly rebalancing because our focus is to attempt to have the positions as they are intended to be. And so I'm actually rebalancing twice a day, just based on... You
specifically?
Yes, I am.
Yeah.
And so just based on market movement, I just want to make sure that the position sizes are exactly what it should be. So it's particularly on the short side of the book. And so when you think about kind of portfolio construction, as we know, I've talked about this being 100% Canadian. It has, I would identify this fund as being an all ideas fund. And so as a result, we have every single security that we cover in Canada represented in this fund, whether it's on the long or the short side. So that will be between 120 to 190 positions at any given time.
Wow, that's big.
On the short side of the book, yeah, absolutely. On the short side of the book, it's anywhere between 40 and 80 positions. We want to have that directional alignment to the market. And so the focus is to and we want to represent the long ideas and the short ideas and on a roughly equal weighted basis to actually represent that accuracy that we do have in the research. And again, going back to that dynamic rebalancing, we're just constantly focused on making sure the position sizes are what they're intended to be with a net exposure of 100%.
So take us into the positioning itself and how you make the selections based on, it's going to be tons of fundamental, but there must also be sort of an approach to the secular versus the cyclical as well. Take us inside that.
That's a great question. So I think of the world in the way of super sectors. So what that would be, we have 4 super sectors here in Canada. So our interest rate sensitives, our resources, our consumer, as well as industrials. And so when I say that we have directional exposure to the market, what that means is we're trying to generate the alpha within the super sectors while being largely neutral across the super sectors itself. And so...
so you're in all of them, but at net, you're neutral.
We're neutral on the super sectors, roughly neutral, and the focus of the alpha being generated is within the super sector. So, for example, when I think about positioning within the interest rate sensitives, so the interest rate sensitives have, since the market's been anticipating these rate cuts, we've seen the interest rate sensitives rally quite a bit quarter to date. And so within the fund, broadly speaking, we like the utilities and the telcos. The way to think about those stocks is that you have roughly mid-single digit EPS growth, mid-single digit dividend yield, and you have valuation that could potentially experience expansion within
because they've been blown out for a long time.
100%.
Yeah.
And within the context of a declining interest rate environment, but also given some of the fundamentals that are happening in the bottom-up fundamentals and competition that's happening, particularly in the telco space. So to the extent that you see a light at the end of the tunnel, you might be able to have some valuation expansion there. We also like some of the diversified financials and insurance names, and that comes at the expense of the banks.
Okay.
Within resources, I would say that we're very much focused on either having a demand catalyst, a supply catalyst, or a valuation catalyst.
New demand catalyst announced yesterday, overnight.
Exactly.
China.
Absolutely. And so when we think about that, lumber looks really attractive.
For China?
No, not for China specifically, but more from a valuation perspective. Here at Fidelity, we have the benefit of being able to wait. We're not necessarily focused on next quarter's earnings or even next year's earnings, but if we see kind of a double over the next, or even a triple or a multi-bagger over the next few years, you get paid to wait. And so...
so sorry, what is that time horizon, just so investors know?
Well, it depends. So it depends on what we see, what the risk reward is.
Okay.
And so it really depends. Like if we see that there's a security that doesn't have that much in the way of downside, clean balance sheet, and you don't necessarily know when the catalyst is going to happen. It could be tomorrow, it could be in 3 years, it could be in 5 years. But it's a multi-bagger, you're being paid to wait.
Right.
So there's no defined time horizon. What I can say is that we're not tied to next quarter or next year, or we can take a medium-term horizon, which is a huge benefit.
That is.
So we do like lumber, we like select copper stocks, some packaging names, and that largely comes at the expense of energy.
Okay.
And then within the industrials and the consumer, that's really the fun part of the index. I mean, overall the index is fun, but
that's where you're playing.
That's where you get to play. Yeah. That's where you get to really stock pick your way through. And so what we've seen is discretionary has been really beaten down this year because of concerns about the consumer. And so there could be opportunities there. Staples have been bid up,
Right.
and so valuations are full there. And so this is where the power of the research really comes in, because our analysts day in or day out are focused on the fundamentals, where there's earnings upside, where there's earnings downside, and what's priced into the security. But to your question on just how we're thinking about the overall positioning of the fund, it kind of walked us through the super sectors. I would say that there are kind of three categories, if I had to kind of broadly speak about the fund. One is you have your kind of defensive category, sure. Which is nicely represented, and whether that's more of the full valuation defensives, but that the earnings trajectory is there, or it's even the interest rate sensitives. You have the names that are kind of the cheap early cyclicals, where you kind of there's not much earnings downside really priced in. The earnings downside is already priced in, and you're paid to wait. And then you have the through the cycle compounders. So I would kind of categorize it across the super sectors in those three categories.
The compounders. And so tell us a little bit about those. I was going to ask you actually about income, dividends, if any of that's important, if it changes the way you look at things one way or the other, or it's a total return for most of these.
Yeah, I mean, it's a total return for most of them. I think it goes into the thought process of what the total return can be. You see more of the dividend stocks, of course, in the interest rate sensitives, and that's where that dividend income primarily comes in. But it's when the analysts think about the total return of the stock, it includes the dividend.
Yeah. So with the consumer, let's hang there a little bit, because it has a lot to do with everything, really. There seems to be this process of looking through, even if there were to be a recession, that the discounting has happened.
Right.
Is that sort of how you're looking at things?
Yeah, well, so it depends. So again, it depends. And so I would say if you think about kind of what's worked this past quarter, and whether it's in the US as well as Canada, it's the interest rate sensitives that we had talked about. But you've also seen, since in the US, the CPI print in July, where there was an anticipation that, okay, we're on this path of monetary easing. You've seen a broadening out of the market. And so as a result, you've seen a little bit of the cheaper cyclicals do better than they have in the recent past. And that is because we're looking through the cycle. But again, you have to be very selective. And so this is where the power of the research platform comes in, because it's important to understand what our upside and our downside is relative to what's being priced into the security.
So just on that, everything else kind of coming into the market, is cap size important? Canada generally has smaller companies than the US, but where do you go up and down that spectrum within the universe?
Yeah, that's actually a very good question. The fund tends to tilt a little more smaller cap. And the reason for this is what I had talked about earlier, because we're trying to have an equal representation of our buy-rated names as well as our sell-rated names, while giving directional exposure to the market. So we don't want any one given security to really dominate that. And so we're really just trying to capture the accuracy within our research. Mm-hmm. And so it does tilt a little small cap as a result.
And that also is just because of what's made up of the TSX is made up of as well. There's some smaller companies. There's only a few big ones.
Yeah, I mean, that's a fair point too. And our research goes even outside the TSX, which would be also represented in this fund.
Okay. When you tell us a little bit about the team that you work with. Let's go back to the research where this sort of all began to an extent. Tell us about the team, who you're working with, and the Canadian focus. But as you say, you got to look further afield as well.
Yeah. So
has it been growing?
The team, we're hiring. Absolutely. Yeah. We have been growing. So just to give you a little bit of context, when I joined the firm in February of 2012, I want to say there was maybe 20 of us. And we were equity long only. And now next year, I think we should hit almost 100. And so across the floor, because now it's not just equity, it's not just Canadian equity. It's we have U.S. equities here, we have trading here, we have a high yield team, we have a quant team. And so it's pretty remarkable the growth that we've experienced. But this speaks to the Fidelity scale that we have, and it's allowing us to take our research bar higher over time. So when I think about the team, we have, I just described the entire investment team, but the Canadian team specifically, this team is a fantastic team that they are just day in and day out. They're just so focused on making fund holder alpha. Right. And so they are just really, really focused on just finding that edge and just really generating good ideas and making sure that they are in the funds and making sure that their calls are right. And so I couldn't have asked for a better team than what we have now. But this team is the team that's putting together the investment process and the investment theses day in and day out. And so they're trying to accurately forecast corporate profitability and earnings. And so what that means is they could be going to conferences to do that, speaking to the management teams to do that. They could be doing site visits, modeling, going through earnings, speaking to industry experts, talking to suppliers, talking to buyers, talking to competitors. But they take all this information, synthesize it, and try to make it into a very simplistic thesis and try to accurately take the noise out of what matters and accurately forecast earnings.
What's the soundbite that you want to share about one aspect of that type of research that you've been doing?
So, oh my goodness, we have so many great stories that speak to the Fidelity scale that we have and the opportunities that we have to generate that alpha. I recall actually back in the day when I was an analyst, with
Hugo Lavallee. Didn't you guys start around the same time?
Oh no, Hugo's been there for longer than I have. He has been there. He came in there, early 2000s, and I probably joined maybe like
2012.
8 to 10 years later. But no, I work very closely with Hugo. He's great. And so I remember going on a trip in January of some year, and I went to Minnesota, so Bemidji, Minnesota. And I remember talking to permitting. The whole idea of the trip was to try and understand if a pipeline was going to be built in the time frame that was indicated and believed by the market. And so I remember having access to talking to the folks that wanted the pipelines to be built, so the labor unions, talking to the folks that didn't want it to be built, so the locals there. And just trying to put the mosaic together, talking to permitting agencies, understanding that process, talking to people in the state government that was, talking to them about their process and how they thought about it. And just putting the mosaic together over those 2 days that I was there, and trying to understand what this means for the stock. And ultimately ended up being a very alpha generating event. And
Wow.
but these are the opportunities that we have here at Fidelity, because we're at Fidelity, to be able to really understand on the ground, do that on the ground research to understand what's going on.
That's amazing. The Mitchie is in the Fargo movies and stories and TV shows and everything. And it's cold there. It's just like Canada, basically. Right?
I don't think I've ever been so cold.
Okay, so how do you monitor the supply / creation of crypto? Is there any reporting that you rely on? So why don't we begin there, and then we can go into what kind of role it plays.
Yeah, absolutely. So maybe I'll just isolate that question to Bitcoin. I can talk about Ether as well. So from a Bitcoin perspective, the actual supply is fixed. And so we actually just went through a halving earlier this year. And so that's actually one of the value propositions about Bitcoin itself, is the fact that we know exactly what that supply schedule looks like through 2140.
Right.
And so we know exactly what that inflation rate is, which is just under 1% at the moment. And even with Ether, that is a little more variable, but at the moment it's disinflationary. And so there's so many different ways to monitor that as well. But so that's how we focus.
You take a look
supply.
at that. Yeah. Where does it belong within this fund, within portfolios more broadly? This is an area you've been looking at for some time.
Yeah, absolutely. So I would say there's no crypto in this fund, but what I would say is that this fund being an alternative and crypto also being an alternative,
right,
they both have very different spots. So this fund, I would say, is the long short is very much a return enhancer, core Canadian portfolio that really isolates that Canadian exposure. Crypto, on the other hand, is more of a diversifier. So I think that just having a 1 to 3% slice within a broader portfolio is all you need in order to get risk-adjusted returns. We've done plenty of studies on this in-house.
In terms of how it correlates.
Exactly.
Yeah.
And so we have gone through a period of time where crypto actually became correlated with the indices.
With growth, basically, at
right.
one point.
But that was more because everything became correlated when we were in this inflationary environment. But now we've seen a little bit of that decouple here. And so what I would say is that we went back and we looked at crypto from 2015 to 2020, and we took a look at, we had added in a 1 to 3% slice of Bitcoin into a traditional 60-40 rebalanced quarterly. We found that the risk-adjusted returns as measured by the Sharpe ratio it can increase anywhere between, depending on the slice, and increase anywhere between 12 to 34%.
Wow.
Which is a great diversifier. The key to that, though, is one would need to really believe in the value proposition of what crypto has to offer, particularly Bitcoin.
I mean, you'd have to believe in it, but as you say, what you measure and the research that you do shows that it does do that. So
absolutely,
maybe you don't have to believe in that being the diversifier. It just seems to work.
Yeah, I mean, it has based on the data that we've seen, but you have to take that long-term view, and you have to really believe in Bitcoin as being that emerging store of value, which is what the narrative is on Bitcoin.
One of the narratives has been that there are going to be central bank coins, digital coins, and that sort of got peeled back in Canada. We heard from Tiff Macklin yesterday talking about rates, but also talking about that. Does that have any sort of connection to the emergence of other types of crypto, of digital currencies, and so on?
I don't think so. I don't think that the thought of a CBDC is in the near future globally, to be honest. I think that the whole reason of having crypto is to have a decentralized currency, and CBDC would kind of take away from that. And so I do think it potentially could evolve to that, but the here and now, I don't think it's months away or even years away. I think that's more kind of we'll see in the next decade or maybe even decades away. Right. But I think that doesn't prevent other tokens from being emerged or Bitcoin gaining more traction from as an emerging store of value, or even Ether gaining more traction, or even the development of those ecosystems. I think it's a potential maturation and evolution of the ecosystem, of the overall ecosystem, but I don't think it really impacts the Bitcoin or Ether, to be honest.
Okay, so it doesn't really come into play when we see headlines like that. It's not really a big deal.
I would say in general, Canada has been more friendly to the crypto ecosystem than other countries,
right.
And so we're fortunate to have the regulatory framework here that we do.
Right. Let's come back to sort of close out with the idea of why Canada, probably why Canada versus the US as well. Advisors and many of their clients making Canadian bucks. Why are we sticking with Canada? What's the case for Canada in this fund being an option for that?
So I think personally that every market will have its moments where it underperforms and it outperforms. And so I spoke about earlier in our conversation, I spoke about the headwinds that are very much consensus out there about Canada, but there's also tailwinds out there. And one would have to keep in mind that, yes, we are a resource-based economy. Also, with rates coming down, that's positive for the consumer. And then the other piece is that we've had crude come down. It's taken a little bit of a step down, which is also positive for the consumer. Yeah. And so these are very stimulative, and the Bank of Canada is very much aware of the headwinds. And it comes down to the pricing of the securities. And so that's where the power of the research team comes in. Despite the headwinds that are consensus out there about Canada, I think it's important to understand what's being priced in. But also beyond that, with this fund specifically, I would say that there will be times where Canada outperforms, there'll be times where Canada underperforms. This fund is all about the research being generated and the alpha being produced outside of the within the research platform, both on the long and the short side. And so at times where Canada underperforms, the hope would be that we would narrow that underperformance with other markets. And then in times where Canada outperforms, we'd widen that gap. And so it comes down to that research being generated from our team.
Portfolio Manager Reetu Kumra, thank you for joining us, taking us through the fund itself and also a deep look into crypto. Thanks for joining us here today.
Thank you for having me.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.